Good morning, everyone. Welcome to the CRE Broker Forum. This is through the Northern Illinois Commercial Association of Realtors. We encourage all commercial practitioners to come on to this session for us to advertise our number one need, whether it's a buyer, seller, tenant, landlord, or something else. We provide this format for NICAR members and anyone interested in doing commercial real estate deals. And when we can, we have presenters at the beginning. And this particular month, we will have Mark, and I'm going to introduce him in just a moment. Everyone is welcome to put their contact information in the chat. Of course, if you have other presenters that you think would be great on this webinar, we appreciate hearing from them. And I'm always looking for feedback. We do take notes that we can distribute. We can also distribute the chat information with all your contact information. And we're looking to integrate with our needs and wants NICAR page. We have a web page, we have a Facebook page, so that we can all get deals done and the rising tide, right? So today we are very privileged to have Mark Gross here. He's going to talk about reducing your federal tax with cost segregation and other tax studies. He can tell you more a little bit about his background. I have had the pleasure of meeting him at NICAR and many other commercial events, and he is a wealth of knowledge. So whether it's cost segregation or other commercial real estate topics, I'm sure he has plenty to say. So Mark, if you'd like to introduce anything further and let us know what we don't know.
Okay, thank you very much, Tricia. I appreciate it. Good morning, everybody. As she indicated, I'm with CSSI. That's the Cost Segregation Services. And what I do is cost segregation and other tax studies to help people reduce their federal tax liability. So that's what I'll be getting into. I've been doing this for the last 14 years with them, and have worked on property types all over the country, from Hawaii to California, Texas, Florida, New England, and even Chicago area. So whenever we're ready, let's go ahead with the PowerPoint and we'll get the show on the road.
Are you able to share? Okay, great.
Okay, that's just my contact information there. Let's go on to the next one. What we're going to be talking about today is why do investors own real estate? And there's obviously a lot of reasons for that. When I'm in a forum, well, I'll ask you, Teresa, why do people invest in real estate?
Well, for most purposes, it's to gain money, but it could be for tax purposes, family wealth. So everyone has a variety of reasons, but usually it's an investment of one kind or another.
So maybe for cash flow, maybe for increased appreciation, hopefully in the years to come.
Could be owner user, right? If they're going to be there anyway, why pay rent? So we have different reasons.
Yeah, that's true. Let's go on to the next one. Is it advantageous to, quote unquote, lose money in real estate? And that's what we're going to be getting into today. Let's go on to the next one. Some people talk about tax loopholes. And tax loopholes is something that benefits the other guy if it benefits you as tax reform. That's from one former senator. And what we're going to be talking about today is all on IRS guidelines. So this is not something that we've made up. It's something we've done over 50,000 times. We have never had a study trigger an audit. We have defended clients who've been audited for other reasons. We haven't had a study overturned. Why is that? It's because we do everything by the IRS guidelines. So we'll get into the detail next. And one thing, an overview as far as cost segregation, go on to the next page, is that we're taking personal property, which can be segmented from real property. So one of the first things you do when you do a cost segregation analysis is you identify what is the land value, because land cannot be depreciated. So what we do is we take a look at the balance of that, and you'll see a 27.5 and a 39 years. Teresa, do you know the difference between that? Why some would have 27.5, one would have 39 years straight line depreciation?
Because the government said so.
It actually has to do with property type. If you have a residential, it could be multifamily, it could be a duplex, things of that nature, it's going to be 27.5. And you're right, it's because of what the government says. All other property types are going to be 39-year straight line depreciation. So that's the differentiation there. And you can see as far as cash flow, we can create an additional $30,000 to $80,000 per $1 million. And it's effective for virtually all properties. Anything 350, I've done some that which are a little bit less, but most of mine are even multi-million dollars. And we've done projects that are over $1 billion actually. And from a return on investment standpoint, it's pretty much a no-brainer. And as I indicated, it's all consistent with the IRS tax code. So let's move on. And here's a kind of a good analogy. I think I need to increase or change the prices on this. The hamburger is no longer $3.99 at McDonald's, but sometimes when I'm doing this in a large presentation, I'll ask the people, who in here remembers the old McDonald's commercials about two all beef patties? Do you remember those, Teresa, or are you too young for that?
I don't watch TV, so I'm a terrible person to ask.
Well, this was a very popular commercial that they had for many years, and I'm not going to sing it for you, but they would talk about all the different parts within the hamburger. So when you take a look at the straight line method, its analogy there is that you just have a hamburger, or in this particular case, it would be a building, and you would just depreciate it over either 27 and a half or 39 years. But what the cost segregation study does is identifies what are the components within that property that can be utilized for that. So that's the analogy for that. So let's move on to the next one. And this will give you an idea as far as there are still going to be certain components within, or I should say elements of the property that cannot be straight line or cannot be accelerated depreciation. So you're going to have your structural components, which are still going to have let's say your brick and your concrete and things of that nature are still going to have to be done over a straight line method. But then there are certain parts that can be depreciated faster into either 5 or 7 year or 15-year properties. So let's move on to the next one. And this will give you, I'm not going to read all these different things, but you can see all the different elements in regards to what's going to be in the real property, which cannot be depreciated faster, and then also the personal property things that can be. Go on to the next one. And this will kind of give you an idea as far as some of those elements. Special electrical carpeting, which is considered to be a 5-year property, and window treatments. Again, I'm not going to read them all, but there's a lot of different variables in there. Let's go on to the next one. And what I like about this one is kind of a graphical depiction as far as what's the difference between doing something from a straight line depreciation versus accelerated or bonus depreciation. So what you can see there is the blue line. The blue line indicates that straight line depreciation. So if it's the residential or property, it's going to be over 27 and a half years. Other properties can be over 39 years. So again, remember, take a look at the purchase price, subtract the land, and you can depreciate them under those elements. Now, when you take a look at the red line, that has to do with accelerated depreciation. That would be based on breaking up things into the components, such as your carpeting, as I indicated previously, being 5-year property, your parking being 15-year property, things of that nature. But then there's something called bonus depreciation. That's the green hockey stick spike there at the beginning, the first year. What that basically did was took cost segregation, put on steroids. There was something from the Tax Cuts and Jobs Act that came out at the end of 2017, which indicated that anything which has a 20 or less year life, you can depreciate that 100% the first year. I'll repeat that. You were able to take anything which had a less than 20-year life and depreciate that 100% the first year. Now that was huge. And that had a sunset clause on it, however. Last year, it went to 80%. This year in 2024, it's 60%, then 40%, 20%, and then it phases out. However, there's something in Washington, D.C. right now where they're trying to resurrect that. And we were cautiously optimistic that it was going to happen earlier in the year. It didn't. As you know, there's a lot of dysfunction going on in Washington, D.C. right now. It did get partially passed, but not fully. So we're just holding our breath, waiting to see what's going to happen with the new election. A lot of people think that regardless of which way the election is going to go in the fall, it's probably bonus depreciation will probably come back, but we'll just have to wait and see what's going to happen there in Washington, D.C. So let's go on to the next page. And what are different building types that can be done with cost segregation? Virtually anything. I've done the vast majority of these. And an interesting scenario is when I talked about how you need to subtract the land. Well, I'll give you an example of one where I was able to take the entire purchase price and use that for cost segregation. And why is that? Well, this was a Walgreens in Florida, whereby the purchase price, it was on a land lease. So when you're on a land lease, the purchase price is going to be, that is what you're going to be able to depreciate because you don't actually own the land. Another example I had of that were some condos in Kauai, Hawaii, where they were based on the condo association. They did not technically own any of the land. So again, that was a situation where we could do that for the condo. They were Airbnbs out in Kauai, Hawaii. Give you an example, we're spending $600,000 for 600 square foot condo. Now, that's a lot per square foot, but in Kauai, Hawaii, you're there for vacation. You're not there to spend time in your room. So that was a good one, and it works for virtually all these. I was talking about the retail strip mall centers on this. I'll give you an example. One client this past year, I did some strip malls in the Chicago area, and I saved him over $2.5 million on his taxes in 2023. And he really needed that because he had a big tax event, and this was able to wipe that out. And he said, with this, I'm going to go out and buy another 20 million. So that's a real live example of how this can work. So let's go on to the next one. So you can see here what we're doing is we're accelerating the tax write-offs. So think about it this way. When you look at your P&L, your profit and loss statement, you're going to have different line items on there as far as expenditures. And one of them would be depreciation. Now, depreciation is a non-cash expense. However, the net effect is the same. It's going to go against whatever your income is. So let's say you have $500,000 in income and you got to pay taxes on that based on your tax rate. Well, what if our study creates an additional $500,000 in depreciation, which is a non-cash expense? The net effect is the same. What it will do is it'll go against that income, and rather than paying taxes on that $500,000, you pay nothing. And let's say our study were to generate losses that were in excess of what you needed for that current tax year. The excess can be carried forward indefinitely until it gets used up. So it's even advantageous. Maybe you can't utilize it all in the current year. You can do that into the next tax year. Frequently, I get asked the question, when's the best time of year to go ahead and do one of these studies? I'm very busy right now working on people who actually acquired properties last year in 2023. However, they're on a tax extension right now, so they don't need to actually file their 2023 taxes until this coming fall. So we're still able to go in and do that for the current tax year, and we're very busy doing that. But what if you have a situation where maybe you didn't do that? I'm working on one right now where I have a client in California who bought an office building, actually bought it in 2022. And I was talking to him yesterday, and he was wondering about doing this. So in a case like that, it's still advantageous because he's only had a year of depreciation on the straight line method. So there's still a lot left that's to be able to go ahead and do the cost segregation on. There is an extra hoop we got to jump through, and that's called a Form 3115, which it doesn't subject you to any sort of an audit risk, but it informs the IRS that I used to do straight line depreciation, but now I do accelerated, and that's the form that we help the clients with. So as indicated before, this is all compliant with the IRS tax code. And the gold standard of this is that maybe you are a real estate professional, or maybe have a real estate professional spouse. I'm working with one East Coast neurosurgeon, very high W-2 income, and on the savings for his properties. In the course of conversation, he said, "Oh, by the way, my wife is a real estate professional." Well, he got it. He understood that that his wife met the qualifications for that, 750 plus hours, maturely participating, all the different guidelines that you need to be able to be a real estate professional. So the losses can not only go against the property, but those losses can actually go against his high W-2 income as well. So that's kind of one of the gold standards of being able to utilize cost segregation in that situation. So let's go on to the next one. These are just a couple of examples that we've had of some cost savings for some clients for some various property types. And this one, the next one, and it even works with ugly buildings. And you take a look at this; it's not very attractive, is it? But what was key to this, and you can't really see it based on this picture, but this particular property had a huge parking area. And with that parking area, we're able to go ahead and do a lot of savings for the client for that particular one. So there you can see how much it was paid for, and then how much we're able to depreciate. It was huge as a percentage of the building. So what we can do, if we go on to the next page, is that we're able to provide a free preliminary analysis for our clients as far as what the estimated tax savings are going to be. We have a simple PDF form you fill out, gives out information about the property. And then within 2 business days, we'll come back with an estimate, which would be, this is what we anticipate your tax savings are going to be, and no obligation, then they can decide to move forward or not. And that's what we do on a regular basis. So let's go on to the next page. We don't have time to get into this, but we also do analysis for what's called a partial asset disposition. Maybe somebody is buying a Class C multifamily and going to convert it into a Class B. They're not only doing the major acquisition, but they're spending hundreds of thousands of dollars, if not millions of dollars, doing a renovation, and we can do an analysis on that. In addition to that, we also have something which is called R&D, Research and Development Tax Credits, Section 179 Energy Tax Credits. Again, with time, I'm not able to get in all the details, but I will briefly mention something here about the green zip tape. We have something where we're able to help people that are doing $10 million and up new construction, adaptive reuse projects, where we can save them $500,000 to $1 million for every $10 million. And I'll give you an example. Last week, I was at a conference down in Chicago. It was an adaptive reuse one with the Urban Land Institute. And there was one of the people that I was talking to there. They're doing a lot of multifamily retrofit or brand new construction. And one in particular I talked to, they're doing the Thompson Center. If you're familiar with that, the state of Illinois building there on Clark Street, where they're taking that building and retrofitting it and going to be doing a lot of renovations on that. So when you have a situation like that, you can take your existing drywall out and replace it with the drywall that, or the tape that we have with our drywall. What it does is it makes interior non-load-bearing walls depreciable, which, again, there's a lot more detail. I can't get in all of it now, but it's very advantageous. I'm doing that for a ground-up construction in the Houston MSA area, Columbus, Ohio, and others around the country. So let's move on. Again, we've done over 50,000 studies. Typically, when you move forward, the timeline is going to be 4 to 6 weeks. We're a little bit shorter than that right now, but it'll ramp up the timeline based on how busy we're going to get later on with the tax extension periods. So the other thing we do too is when typically what happens is when we deliver the study, we just provide it to the CPAs, and I don't hear from them. However, sometimes there's some CPAs who aren't well versed in real estate. In that particular situation, what we'll do with no additional cost is we'll get on a conference call with them and walk them through the process as far as what they need to do to take that study to apply it toward their clients' tax returns. Okay, that's pretty much it. I kind of breezed through that. I know it's a lot of detail, but let me know if there's any questions.
Thank you, Mark. If anyone has a question, if you could please use the raise hand emoji down at the bottom of your screen. I have a couple questions. When do properties work really well for huge tax savings versus it's probably not worth it, Mark?
I find that it really is going to be worth it for any property type. It's some of them you might have an industrial property where the percentage is going to be lower than, let's say, like a medical building or a multifamily. So you might not get as high a return on investment on that, but it can still be advantageous. I'll give you an example of one industrial property I did here in Bedford Park a few years ago. If you get that mailer in every week in your mailbox, which has the grocery store ads, all those papers. I actually did the study on the printing press that was in Bedford Park that prints all those things for the Chicagoland area. Now, from a percentage standpoint, when you think about industrial property, you're not going to have as many components within that, except for maybe like in the office area compared to the industrial area. But still, it's going to be advantageous. So, and to follow up on that, sometimes a lot of people that will say, I'm thinking about buying a property. What's the best property I should get for cost segregation? And I'll say, I think that should be a secondary consideration, quite frankly, even though that's what we do. Your first priority should be, what's a good investment going to be? What type of return on investment am I going to get from cash flow, appreciation, things of that nature? And then the cost segregation is just going to be cream on the top.
Great. Thank you, Mark. Dr. Mustafa, you have a question?
Yes, I do. Mark, you mentioned you had a client that his wife was a real estate broker. Can you explain that impact of the cost segregation that was involved with the real estate broker because he was married to a real estate broker?
It was a real estate professional, and I always do a disclaimer, and that is talk with your tax counsel to find out what your particular situation is, whether or not you qualify, because there are some strict guidelines with the IRS as far as how many hours you work in that, you materially participate in it, things of that nature. The key is, if you qualify from the IRS standpoint for being a real estate professional, then you or your spouse, I guess from a spouse standpoint, any excess savings can actually not only go against the property. Let's say you have your net operating income on the property and you can wipe that out with the depreciation, but also whatever your spouse's W-2 income is. So again, what I would suggest you do is take a look at what your circumstances are, make sure that if your spouse actually does qualify for that, and that's how it works. Does that answer your question?
Yes, I mean, just to realize that there's some other benefits if you have somebody in your spouse is a real estate broker with doing, I guess, full-time real. Yes, so yes.
Okay.
Thank you. Peter, you have a question?
Yeah, quick question. As far as the property itself, obviously with depreciation, they got to pay that back in the end. What would be the shortest period of time, hold time, for the property that you're doing cost segregation on? What really makes sense tax-wise?
Yeah, that's a great question, and typically I address that during my presentations. Thank you for that. What we suggest is that you have at least a 3 to 5 year hold. As Peter is referencing, there's something called a recapture tax. And what we want to do is make sure that the return on investment that you can get on the savings is going to far and exceed whatever the recapture tax is going to be. And typically that can be done in the 3 to 5 year time period. I've had a client who had a situation where he said, I know I'm going to be selling this in 2 years. I know about the recapture tax, but I know about the amount of savings I'm going to get. It's going to far outweigh whatever that recapture tax is going to be. That, quite frankly, is unusual. I wouldn't suggest that people do that after a year or two. That's why we suggest the 3 to 5 year time period.
Okay. I'll wrap it up with the last question that I have. Is there any situation where it was a big surprise at how much savings there was. Like, you wouldn't have thought that, maybe the owner wouldn't have thought of, or you wouldn't have thought, like, do you have a surprising moment that you could share, or a surprising story?
Yes, amazingly enough, one property type that has the highest is going to be a mobile home park.
Mm.
Now that surprised me. I would not have anticipated that. Depending upon the situation with all the infrastructure that you have within those property types, from a percentage standpoint, it can be huge. And I've done a number of those, not in Illinois, but in other states where they've got a lot more mobile home parks, and it can be very advantageous for that.
Great, thank you. I appreciate you coming on and presenting the basics of cost segregation. Mark will leave his contact information in the chat, as well as this recording will be available on the NYCAR CRE Broker Forum page. I just want to mention a couple other things. If you have presenters, and I'm sorry about the lag, but if you have presenters that you would like to hear more information on, whether you have contacts or give me suggestions, I'm happy to hear it. You can reach me at Teresa Mueller through Trellium 630-715-9999, or my email, info@teresamueller.com. And we're happy to put presenters forward, as well as come up with ideas for what's happening next, which is our needs and wants networking session. So anyone who comes onto the forum, we're taking notes as to what their client needs are, and we're hoping to integrate that with all of our NYCAR needs and wants pages. So we have that on the webpage. We have that on social media sites, especially LinkedIn. So we encourage you to get involved so that we can get deals done. That's why we're here. Thank you very much, Mark, for that presentation. And afterwards, we will end the recording and have the needs and wants. Next month, we will have Johnny Noon on to talk about a few different commercial real estate topics. So I hope you can make it next month. Thank you for listening, and have a wonderful day.